Hey, my friend, Steve here. Most people think that they're saving enough money for retirement, but the numbers tell a different story. The gap between what people have and what they need to retire comfortably is often wider than they realize, and the gap tends to get bigger every year. So in this video, I'll show you exactly how you can calculate how much money you need to retire comfortably, whether you plan to stop working at age 55, 60, 65, or 70, and what to do if you're behind. So first, let's understand why the average American retires with less money than what they need. If you were to look up the national average retirement income, it ranges quite a bit, but it falls right around $75,000 per year. Now, when I hear $75,000 per year of income during retirement, personally, if I live modestly and I don't have too many expenses, that sounds okay. The problem, however, is inflation. If I were to retire 40 years from now, how far do you think that $75,000 will go? An easy way to calculate this is to go back 40 years. That'll put us in 1985. So if I were to buy something in 1985 for $1, and then I buy that same item today in 2025, how much do you think it would cost? It's just about triple. So it'd be $3. So what that means in terms of retirement income is if my income back then was $75,000 and I want to maintain the same lifestyle I had back then today in 2025, well, it means my income would need to be triple, which would be $225,000. That's inflation. It's the silent killer. If we go another 40 years into the future, the question is, that'd be what, 2065? If my income is $75,000 per year, what will inflation do to that? If history repeats itself and everything triples in price, I would just divide that by 3, and my $75,000 would feel like $25,000. So again, inflation is the big problem. So how do you actually retire? You can't hit a goal or number that you haven't defined. So step 2 is knowing your retirement number. Where I would start is with your income, gross income. How much is coming in? Then second, how much is going out the door to taxes? Then look at your big expenses, like your mortgage, car payments, maybe college tuition. Then calculate your regular expenses, like food, gas, and everything else that comes with life. Next, we want to calculate our fixed income sources that we know we'll have in retirement, meaning what's the sure bet? First, I usually like to look at Social Security. Second, if I have a pension or any pensions from old employers, I want to include that. Rental income, maybe I have annuities. Those can be nice because they do provide a guaranteed income stream. I try to keep it as simple as possible, and I like to build it up myself. This way I can really understand it, and then I can speak in an educated manner to the client that I'm discussing this with. If it seems hard, everything I just mentioned, I promise it's not. It just takes a little bit of time. Now, if you said, I don't have time to sit down and figure out my spending, I totally get it. I would use an app. There are hundreds of apps out there. Pocket Guard, that's one. Good Budget. Rocket Money is nice. I've used that before. I know Dave Ramsey has one called the Every Dollar app. You know, every app out there has pros and cons. The first step is really just getting started to try to figure out how much money is coming in and where it's going. Once you have your retirement target, the next step is figuring out how you can hit it, and it starts with understanding how much money you'll need to save, and then how you can use the money you've saved to generate the income you want later. So for example, if you know that you need to generate another $50,000 per year in retirement, you might need to save about $1 million. I'll walk you through this. A lot of retirement planners will use the rule of 4 or 5%. It involves building a big nest egg while you are working, then putting that nest egg into a conservative retirement account and living on the interest. So $1 million, put that into an account, never touch the principal, get $50K per year, and when you die, that $1 million is passed to your beneficiaries. This has been a popular strategy for a long time. It works really, really well for people who have accumulated some very big nest eggs, and the interest that those nest eggs produces more than enough income for them. But here's how this would work. Let's say you said, hey, I like this approach. The amount of money I need during retirement is $125,000 per year. When I retire, I'll have $35,000 per year. My spouse will have $30,000 per year, and I have some rental properties that will produce me conservatively a net of $25,000 per year. When we add the Social Security for you, your spouse, and then the rental income, you can count on $90,000. Your target, however, was what? $125,000. So the nest egg approach, how would that work? Well, let's say that while you were working, you built your nest egg to $700,000. Well, $700,000 at 5% would produce $35,000 per year. If your income from Social Security and your rental properties is already $90,000, add the two together, there's your $125,000. If you said, well, 5% is a bit aggressive, I'd like to go more conservative than that, but I still want the $125,000 target, well, another way you could approach it, if you said, I want to look at 4%, that nest egg would need to be about $875,000. Because 4% of $875 gives you, guess what? $35,000. Plus the fixed sources of income, which give you a total of $90,000, and that's how we come to the target. Now, if that seems out of reach, or you're not comfortable taking on that amount of risk, don't panic. It's okay. There are tools out there that can help you close that income gap without taking on the risk. A product that gives a lot of our clients peace of mind is an annuity. Now, annuities do have drawbacks and they are definitely not for everyone. But if I am purchasing them based on the guaranteed income they'll produce, I think they can be excellent personally. I recently met with a couple who are in their mid-50s. The husband, let's just call this Mr., will have Social Security of about $29,000 per year. So that's his Social Security. The wife will have Social Security of about $26,000 per year. They've got two rental properties that are producing $40,000 per year, but they wanted to shoot this conservative. They do have mortgages on these. There's always costs that are involved as well. So we'll just call this rentals. Let's assume it produces us a net of $20,000 per year. Those are their fixed income sources. The total income they have from these sources is $75,000 if you add those up. They had about $500,000 in IRA accounts. And what we looked at is moving that $500K into an annuity. They're looking to purchase this in their mid-50s. Here's why. They want to retire early. 62 is the earliest they can take Social Security. So what the annuity will guarantee them at age 62 is $52,000 per year. And that's based on rates today with the different companies and products that we quoted. So if you add that 52 now, give them a total of $127,000 in income. They have this income of more than $125,000 per year, and they're still extremely liquid. We've got enough money for retirement. We thought we would need less than that, so that's great. And in the event we need more or want more money at any point in time, we've got the assets to do that. So in this particular case, I did like an annuity a lot because it was simple, provides guaranteed income. If they die before they get their principal back, the principal balance would be paid to their beneficiaries. We typically go with that with annuities, but the guaranteed income stream gives them the peace of mind that they'll have that target income they're looking for throughout the rest of their retirement. So when it comes to annuities, again, they're not for everyone, but for the right person, particularly at the right age, they can really help remove that fear of running out of money. How it works is I give the insurance company a pile of money. In exchange, they provide a guaranteed income stream. In some cases, I can start the income immediately. Could depend on my age. Usually it's after 59 and a half. What you'll also find is the longer you wait, the greater the income will be. I can start taking it at 62 and get $29,000 per year. But if I wait until I'm 67, I might get $35,000 to $40,000 per year. The longer I wait, the higher the payout is. So you can play it right with annuities and use them as a tool to help fill the income gaps in your retirement as a potential option. Now, if you're looking for a place that offers tax-free benefits, you've got a couple options, but you are fairly limited. What we don't want to do, if we're looking for tax-free income down the road, is fully rely on our 401k or IRA. A 401k can be a great way to accumulate wealth and grow your money because it grows tax deferred. The money that you contribute to your 401k is typically done with pre-tax dollars, and you're not paying any taxes on the interest as it's growing. So it's going to grow quite quickly. However, when you take that money out, you have to pay income tax on everything. From a tax-free standpoint, it's the opposite when I eventually want to take income. Now, with that said, I do work with a lot of clients. Some will use Roth accounts, and others will use cash value life insurance. Those are typically the two most popular routes I see people go if they're looking to produce income and they want that to be tax-free down the road. There's several reasons. It's because of the guarantees. They can easily predict what that cash value will grow to, especially when we look at it conservatively. But then also, they had the income that they could use to pay that executive when they retired, and then the tax benefit was huge. That's exactly what I did when I started my business, what we did for corporations, but for individuals. Here's the big thing. Whole life insurance, it's easy to get a bad policy, meaning it's not going to produce any type of cash value if I don't set it up right. So with a life insurance policy, a bad example would be if you get a policy, someone recommends you put away $10,000 per year, sometimes it's $100,000 per year, and your first year cash value is zero. Another bad example is if your first year cash value is $6,000 or $7,000. It's not high enough. That's a bad example. What I would do here, here's the good example, is if I pay the same $10,000, the first year cash value should be somewhere between $8,000 and $9,000. That's the big thing. If I see 80 to 90% of whatever I pay, whether it's $10,000, $100,000, whatever, that's an indicator that the product was set up with minimum expenses and maximum cash value. That'll give me the most cash value now and also the most cash value long-term. I say that because when we look at real policies that have lived the test of time, that's been the model. Guess what we do for corporations? That right there. They want the cash value maximized as an asset on their balance sheet. This way they've got the money there that they can use right now, and they can also use it for income down the road. This leads me to my last point. No matter what you decide to do, it is so important to work with someone who educates and empowers you, not pressures you. What I would not do is take advice from what I like to call fear mongers. I'll see financial advisors say things like, well, life insurance should never be mixed with saving money or considered an investment. But the follow-up will be, the product always under-delivers, and you can get higher returns if you just put your money into the market. Your agent is trying to make a massive commission on you because whole life insurance products always pay massive commissions. Instead of educating consumers about their products and services, they tend to attack each other. What are you going to think of me if I bash someone else? Some people think it's entertaining when people fight with each other online, but how I look at it is it's not the right thing to do, and it also doesn't get me any business. When it comes to working with any professional, what I would try to do is keep an open mind and know that every product and every strategy has pros and cons. While some might not be great for you, it might be great for others, but we have to be willing to approach it with an open mind. The huge danger is working with someone who's biased, uninformed, and just tries to scare you out of even speaking to their competition. It happens so much in the financial services industry. I think it happens a lot just in sales in general. Here's what I see the best decision makers do. First, speak with multiple professionals. It's okay to talk to more than one person. You're not betraying the agent or advisor. You can get multiple opinions. Second, get references. Third, read reviews from clients, not competitors. So important to make that distinction. 4, if it's a big decision, have a third party interview the person before you even consider working with them. Remember when I met with a couple who are worth more than $100 million? Before they considered working with me, we had an initial meeting, then they brought in their tax attorney to qualify me before they decided to move forward at all. It's okay to do things like that. 5, have an idea of your goals before the meeting. And if you don't have goals, you say, well, I need someone to provide guidance. that's okay. One of the things we like to do is send a simple questionnaire that asks for someone's current income, assets, liabilities, and then we'll usually just put 3 questions in there to collect information from them so we can help provide some guidance or have an informed discussion. That helps a lot. And then the last thing I would do is work with someone who is approachable. If you're comfortable speaking with that person, you're going to be able to ask them questions without feeling judged or like, this is a dumb question, I don't want to ask them. This stuff happens all the time in this business. Remember, whoever you are working with is going to get compensated in one way or another. If you enjoyed this video and you'd like to see a case study on how we helped someone prepare for retirement, you can check out this video here.